Welcome to PlanStrongerTV. I'm your host, David Holland. At each stage of life, Americans face a different set of financial risks. Early in our careers, the risk of job loss and disability. Later, it may be long-term care, inflation, and longevity. On today's program, I'm joined by Dan Slater, an actuary who will help us understand why it is prudent to transfer certain risks to insurance companies. Let's roll. And welcome back. Glad to have you with us today, and I'm very excited to bring in a guest from out of town visiting us here in Daytona Beach, Florida, in the studios at WDSC Channel 15. He is Mr. Dan Slater. Dan, welcome to the program.
Thanks, David. Great to have you come down here. Yeah,
absolutely. So, Dan, ladies and gentlemen, is an actuary, and you say, "What's an actuary?" Well, we're going to talk about what an actuary is. I invited Dan to come speak with us because I want to talk about shifting risk to insurance companies. Why we want to do that, how to do that, when it makes sense. So, Dan, let's get the audience acquainted with you a little bit.
Sure.
Tell us a little bit about your background and what you do as an actuary. First, what's an actuary?
Yeah, what's an actuary? So actuaries are kind of good at math. Let's start there. So it's a lot of math-based stuff. But I kind of start back a little different of who employs actuaries. Generally, you're going to see insurance companies and the government. Okay. And a lot of that has to do with ways in which you manage risk in a broad way. So things like insurance, homeowners insurance, where you're pooling risks, things like Social Security, where again, there's large amounts of people. How do you assess what those risks are, and then how do you manage it? So the actuaries kind of do all the number crunching, the risk analysis to be able to make some decisions on and say, how do I want to manage that risk? What options do I have?
Okay. So, and you do this work. You've worked as an actuary for an insurance company for 10 years?
10 years.
10 years. Yeah. Wow. That sounds like a prison sentence or something. Okay.
Yeah.
Sorry, that was too easy.
No.
Okay, so, and you, after doing that, you started your own company, and it's called Core Income Advisors?
Yes, correct.
All right, and what do you guys do?
Yeah, so we're up in Minneapolis. We're a national-based firm. We work with financial advisors. Obviously, that's kind of where we've connected on this. But really kind of after the 2008 crisis, where there was a lot of questions on insurance policies and the market and is everything I'm doing right for retirement? I mean, a lot of people had those questions. That's kind of when we started our firm because advisors had a lot of questions. Sure. If you do a lot of different things, stocks, bonds, mutual funds, annuities, life insurance, how do you become an expert in all of those? So that's kind of our firm, is we kind of provide a third-party expert consultant to the financial advisor. So
that's a very important thing, and different advisors work in different ways, and some of them have a staff, some of them are on their own, and I know you do a lot of work to support the advisor maybe who doesn't have as much staff to support them. So in the work you do, you see a lot of focus, especially for retirees who are trying to address how they're going to not run out of money while they're in retirement.
Right.
And so that's really going to be one of our focuses today, is that we have this thing called longevity risk.
Right.
And it sounds like, well, you guys make it sound like longevity is a bad thing.
Right.
And it's not. Longevity is a wonderful thing, but you need to have the money to go with it, right?
Right. Right. And you got to make the right decisions with that money to make sure that that money lasts.
So the longer we live, there's a greater risk, obviously, of running out of money. Because if you live, 20 years in retirement versus say 5 years in retirement, that money's got to go a lot longer. Right.
Well, and the big thing there is you have to make some educated decisions on how long that is. Is that 20 years? Is that 25 years? And you have this dynamic now where people used to live on things like Social Security. They have their pension, which that doesn't exist quite the same way.
Sure.
And now you have this large 401k, and not only do you have to make it last for your life, generally you also have to make it last for your spouse as well.
Right.
So again, how far does that go? Look, there's a lot of things you can use. Obviously, things advisors have access to, different tables to say, how comfortable with that risk do we want to get?
But it's still, you're still accepting the risk when you try to play that game of I'm going to do this, I'm going to plan on living this long, and I'm going to invest this way. There's still risks there, and I guess that's really back to the core question is, does it make sense to transfer some of the risk of how long you live to the insurance company? Because insurance companies offer these products, obviously.
Right. Well, and kind of the building popularity of that is because the pension has gone away, which was the ability for you to have that peace of mind to know that you would never outlive that paycheck. And that's really where the annuity market has come in, because it is one of the only financial vehicles that can guarantee you an income that you can't outlive. Again, we're in all kinds of different markets these days. When you used to get 5-6% interest on your investment and you needed to live on 5, well, that's pretty easy. You just spend your interest and you get to keep all your money.
Right.
Well, when interest rates may be lower at 1 or 2 and you need to live on 5, well, you're going to be depleting your assets. So again, how long can you make that last, and how much of that risk do you want? So like you said, with risk, it's not about getting rid of it completely. It's about understanding and managing it to something you're comfortable with.
That's perfect. I could not have said it better, Dan. You understand the risk, identify it, and then decide how much of it you're going to accept or not. And I want that to be an active decision. And a lot of people don't. They just kind of ignore it. They shy away from it. They dismiss it. 1, because maybe they don't fully understand it, or 2, they don't really want to deal with it, and they know that there is a risk there. So it's a lot like, maybe a good analogy is looking at automobile insurance. You mentioned that's one of the things that insurance companies use actuaries for.
Yeah.
So with auto insurance, you are going to decide on the amount of the coverage you need, or there are certain state rules, of course, but you're going to decide on the deductible.
Right.
How much of the potential risk of loss are you willing to accept?
Right.
And so we make those decisions every day, but when it comes to our finances and how long we're going to live and how long that money's got to last, in the planning work I do, working with clients, I am always looking at, all right, we need to identify all the risks and how are we going to address and mitigate each one. And then if a client wants to accept a risk, fine, let's just make sure we're doing it with open eyes.
Right. And I think that's kind of the big thing. I was actually reading a white paper on the airplane down here, and it talked about the biggest retirement crisis right now is for Americans to understand distribution math, not accumulation math.
Yeah.
And that's kind of the 401k, getting rates of return on our money. That's all accumulating. But how do you make decisions once you have to start distributing that money? And with that pensions going away, that's kind of what that white paper is saying is that you got to become educated.
Well, and it's funny, Dan, when you and I talk about distribution and accumulation, we're very fluid with all of this, and we're used to talking about these strategies. When you say distribution and accumulation, the audience, that sounds like you're talking Portuguese. I mean, it's another language, and so this is where people need to, as you say, do their research. They don't necessarily have to read white papers and the technical stuff that is produced, but they need to familiarize themselves, and they need to understand that the things you do while you're accumulating are different than the things you do when you're retired.
Yeah, when you're spending your money. And one of those things we just talked about is how long do you expect to live? You can Google that, or you can look at tables, and you'll see a wide range of different answers. I always say, you see in the paper quite often, Social Security table kind of saying this is how long you expect to live. Well, that table includes half of America that doesn't have any assets for retirement. So if you have assets, you got to start to understand, who are you identifying with? The people that have money, we know because of access to health care, different reasons, they have a longer life expectancy. So again, there's a lot of numbers out there, but are they the right numbers? And obviously that's a difficult conversation or difficult thing to learn. That's the good thing about working with people in this field.
Absolutely. Well, and so we mentioned annuities being a way to transfer this risk, some of it, to the insurance company. And what's basically happening is you give the money to the insurance company, and they're going to, in its most basic form with the annuity, give you a guarantee of income the rest of your life. So, and there are different variations on annuities, which we don't necessarily have to dig down into today, but the idea of that is you're saying, look, I don't want to bear all the risk. I know I need the income every month. So, hey, insurance company, here's some money, pay me income and my wife's or husband's income for the rest of their lives.
Right. Yeah. I mean, I always think of it. You're giving them your money, and then they're going to give you paychecks.
Right.
You know, when you retire, that's kind of what you do, right? You become your own company. You have to decide how am I going to have enough money to cover my expenses and so on, and you know that's what they're going to do. They're going to give you a paycheck for the rest of your life, and quite often, you know, it's going to include your spouse. So if you end up passing away, that paycheck's even going to continue there, and you know, again, that could be into your 80s, it could be into your 90s, and now you're seeing now into your 100s. So, you know, that kind of helps decide, well, you know, how much is that worth? What is the annuity really doing for you?
Yeah, and I think that it's really about not just the math, and I know that that's a big part of it, but it's also about peace of mind, and also a relaxed investor is a good investor.
Yeah.
And so if part of your money has been moved to where the insurance company is paying you every month, that changes how you view the investing part of what you do. You can be a little more patient and not necessarily so reactive to what the market may do. If you have all your money in the market and the market drops 10%, you're going to be much more likely to want to pull that money than if you have part of the money in the annuity giving you income. Well, then you don't have as much of a reaction. Say, well, I don't really need that money right now. I can wait for it to recover. You're not as anxious or on pins and needles as I said.
Yeah, I mean, consistency and predictability goes a lot, you know, in a mindset.
Yeah. So if we go into these types of things and we look at annuity or other parts, what I think you and I both would agree on, Dan, is that not necessarily that becomes a financial plan getting an annuity, but that it can be part of an overall plan.
Right. Yeah, and I think that's really the big thing is how does that interact with your other assets? Like you just said, what availability does that to let you do other things, growing your money with other assets, and again, that predictability of income. Really, again, we talked, there's different annuities out there, and you see lots of different things about them, but you know, we're really talking about cash flow. Right. You know, an annuity that is distributing money back to you is really that income focus we're looking at.
Right. And that's cash is king.
Yes.
Yeah, right?
Yes.
So what are some of the cautions maybe for people to have in their mind as they are evaluating some of the different choices in the marketplace? You kind of spoke to this, Dan, that there are a lot of different types, and there definitely are a lot of types, and there's also a lot of different opinions about different annuities and what might be done. Yeah. So what do you say to people about maybe some cautions when you're looking at annuities in general? Yeah,
and one of the biggest things is always to focus on what is it really doing for you. So, you know, I always say you're giving them your money. When and how are they giving you your money back? Right. You know, there's a lot of features that are before you start taking your money out. You know, certain types of roll-ups or guarantees of return, but that's still not money back in your hands. It's during that waiting period. So that's an important thing to really know is when you look at that annuity, when and how is that money coming out? And again, like you said, there's a lot of varieties out there. There's a lot of different options. What type of filtering process does an advisor like yourself work through? You know, what are you looking for, and then why are you making that as a potential recommendation? Right. There should be some substantiated bullet points there.
You mean there should actually be a reason and basis for making it a recommendation?
Right.
Well, and that actually brings me to another important point, and I want to leverage your experience because I know that you and your firm do this every day. You know, there are some advisors that will just use one company all the time. Right. That's their choice. Some advisors are very deliberate and determined to evaluate for each client what company makes sense for them. And there's different degrees of independence and desire to put the client first. And there's an ongoing debate in the financial industry about that. But from your perspective, working with agents all over the country, what would you say to the person who's thinking about getting an annuity about that process, how important that really is?
Well, and that was a big part of the way in which we started our firm, my firm, was that we're an independent provider. So we have multiple companies on our shelf. That gives us the ability to pick the right product for the right situation. I know, and that's the same, at the advisor level. Sure. What type of affiliations do you have? Is there, the big ivory tower somewhere that's trying to get you to, pick one product over the other, and that's kind of part of the process. And I think as you work with an advisor, not just knowing what product they would want, but what was the process of selecting it is very important, and there's certain levels of understanding that, but I think a good advisor has a good documented process on this is why we're choosing 1, 2, or 3 potential options.
Right. So that's not an unreasonable expectation for the consumer.
I don't think so.
To expect that the advisor isn't just, here we go, ready, I'm gonna
Right.
get you a recommendation.
Right.
Reach over. They don't have to look because
Yeah.
everything's the same and everybody gets the same recommendation. To me now, I'm a little bit, what's the right word? A little bit exacting on that, or a little demanding.
Yeah.
I think that that's lazy.
Yeah.
I think it's lazy when an agent or advisor just reaches over and everybody gets the same thing.
Right.
Can you just put a little effort into this
Right.
and look at choices and evaluate what's best for the client, and not just recommend the soup du jour,
Right.
what is the special for today, but
Right.
actually look at the person's situation. And that's where what you do is so important, is you're helping advisors and agents look at what's out there and make the best recommendation for the client.
Right. And look, these things are constantly changing. Our environment is constantly changing, and there's no plan or no client's retirement that's the exact same. So how can I look at an annuity and say, well, that's the annuity for them? And again, that's just part of what we've helped build, and the way we interact with your firm is consulting and finding, going out in the field and picking the best flower that fits that client's situation.
That's true. And I think it's really important for the consumer, the retiree, the person who's thinking about retirement down the road, to be their own advocate, and then also expect their advisor to be their advocate. And financial advisors and insurance agents and all of that group of people who are offering to help clients really need to bring that kind of advocacy to the table for the client.
Yeah, I think so. And I always go back to fundamentals, right? If you're going to give somebody your money, when and how are they going to give you back your money? And as we talked about, the annuity is well, even if you ran out of your money, they'll continue to pay you their money. And so I always break it down into just some simple math. It doesn't have to be all complicated, but understand how that cash flow trade actually happened.
That's very good. Very good, Dan. Dan Slater, ladies and gentlemen, coming to us from Minneapolis, right?
Yes, correct.
All right. Well, we're glad to have you with us, and we'll be definitely talking more about this with Dan on a future program addressing other risks. So be sure to talk about that again. So thank you, Dan.
Yes, thanks for having me, David.
You're very welcome. Okay, it's time for the viewer questions segment of the show. Today's question comes from Lynn Wood in Daytona Beach, Florida. Lynn writes, I'm scheduled to take the first minimum distribution on my IRA. Can I put some of that money into my Roth IRA? How much can I contribute? What would be my best choices to avoid paying taxes on this money again? This is a very good question, Lynn, and it comes up fairly often when I'm helping people plan how they will take their required minimum distributions, RMDs. Here's your answer, which I'll give to you and the viewers in 4 parts. First, you can only make Roth contributions if you have earned income from employment. Gross income or even taxable income is not the same as earned income. Dividends, capital gains, interest, and Social Security don't count. You've got to have income from employment to make a Roth contribution. Second, you can convert part of your regular IRA to a Roth IRA, but you have to pay the tax on the amount you convert. And by the way, whatever you withdraw from your IRA is treated as ordinary income. It doesn't really matter how you invest your IRA, a certificate of deposit, annuity, mutual funds, bonds, stocks, gold, whatever. If those things are inside an IRA, the withdrawals are still taxed the same way, which is ordinary income. With all that said, it's generally better to use non-IRA monies to pay the income tax on the amount you convert from your regular IRA to a Roth IRA. Third, which is more directly to your question, you cannot treat the required minimum distribution you take from your IRA as a Roth conversion. If you want to convert some or all of your IRA to a Roth IRA, you have to take that amount out of your IRA on top of your required minimum distribution. For example, if your IRA is worth $200,000 and based on your age, the percentage you're required to take out is 4%, that means your required minimum distribution would be $8,000. 4% times $200,000 is $8,000. That percentage goes up, by the way, as you get older. Okay, back to the $8,000 required minimum distribution we just calculated. This $8,000 can't be used or treated as a conversion of your IRA into a Roth IRA. If you want to convert some of your IRA to a Roth IRA, it'd have to be an additional amount you withdraw above and beyond the $8,000. So for example, if you want to convert another $10,000 of your IRA to a Roth, that would mean you need to take out a total of $18,000 out of your IRA. Of course, there are several tax considerations and implications when making Roth conversions and when making large withdrawals from your IRA, 401k, or another type of tax-deferred account. Okay? Anytime we look at something like this in my firm, I always bring in the CPA from our tax department for his analysis and input. And fourth, it's important to note that after you take your required minimum distribution, you can do whatever you want with that money, including reinvesting it. That might mean using it to pay off debt, build up your emergency fund, or do something fun. If you want to reinvest and don't want to pay tax on those monies, you'd have to reinvest that in a way that doesn't earn anything or something that earns tax-free interest, such as a muni bond. I don't normally recommend municipal bonds because the interest rate is usually low compared to other choices, and you really don't get that much of a tax advantage unless you're in one of the higher tax brackets. I will usually advise people to take their RMDs and build up their cash funds or invest those funds into a brokerage account with mutual funds. Of course, I'm sharing some general information with you, ladies and gentlemen. No advisor should say exactly what to do without reviewing a person's individual situation. There's a lot of moving parts and things to consider. Before I wrap up the question, let me add one more thing. For those of you who are not familiar with what a Roth IRA is all about, here's an overview. A Roth IRA is a special type of IRA with the distinction that you've already paid the tax on the amount invested. And if you follow certain specific tax rules, all the earnings are tax-free when you take withdrawals. There's also no required minimum distributions on a Roth IRA. Again, you've already paid the income tax on the contributions to a Roth IRA. With a regular IRA, whatever you put into it typically hasn't been taxed yet. The contributions to a regular IRA are called pre-tax contributions. There are generally two ways to get money into an IRA. One, by contributing to a traditional IRA, as permitted under the tax rules and your personal situation at the time, or two, rolling over a 401k, 403b, lump sum from a pension plan, or some other employer-based retirement account. The same can be done to get money into a Roth IRA. You can make a contribution when you file your income tax return, or you can convert an existing IRA into a Roth. Here's a question that Lynn didn't ask me, but many of you might want to hear the answer to this question. Is a Roth IRA a good idea? Sure, for some people. Like a lot of financial choices, it depends on each situation. I've told some people to make Roth contributions or to convert part of their IRA into a Roth, while I've also told others not to. It just depends on the situation. Okay, great topic. Do you think I prepared a little bit for this one? Just send me an email if you have a question, if you'd like me to answer on the show, and I'd be happy to do it. I might even prepare my answer for you. Thank you. Before you go, I've got a couple things I want to add to our discussion of IRAs and minimum distributions. For those of you who've built up a large IRA that you don't really need to draw on for income, I'd like to say two things. First, I know how you did it. And don't worry, I won't tell anybody. You worked hard, you made prudent choices, you made sacrifices, and you saved your money. That's usually how it happens. Congratulations, good for you. The second thing is if you have a large IRA, 401k, 403b, or some form of retirement plan or investment that you haven't paid taxes on yet, there is special planning that you can do to make the most of what you've accumulated for yourself, for your family, for your beneficiaries, and for charities if you're so inclined. One thing you may not know about me in watching this program is I'm passionate about helping others get from where they are to where they need to be. That's why I'm a financial planner. That's also why I help people leverage their IRAs and similar accounts into tremendous gifts for their families and for charities. With some careful planning in advance, you can leave an incredible legacy. You really can help others. I helped one gentleman, for example, turn a $1 million IRA into a $2.5 million endowment for a charity. I helped another person reduce the tax bite on the sale of stock that had grown a lot. We put it into a special trust, and she will get income from the trust during her lifetime, and her favorite charity gets what's left over when she dies. Speaking of trust, You can also control how quickly your heirs liquidate your IRA upon your death. I tell my clients all the time, how you give money to your heirs is just as important as how much you give them. A trust can be a powerful part of your overall estate plan. If you have a large IRA, take some time to look at your options. If you do that, let's say it together. You'll plan stronger. Thanks for joining me.
If you would like more information about the topics and our guests featured in this series, please visit our website at PlanStrongerTV.com. Also, if you have a question you would like David to answer, please send it to questions@PlanStrongerTV.com.